When a public company releases its official reports, those dense 10Ks and 10Qs, our attention usually jumps right to the numbers, things like revenue, profit, and cash flow. But there's another story being told, a sort of forward-looking signal that's hidden in plain sight. It's encoded in the very words that management chooses to use. Today, we're going to explore how to decode this language of the market by diving into SEC Filings sentiment analysis.
So here's our path for today. We'll start by looking beyond the numbers to really get a handle on the core concept. Then, we'll get into the mechanics of how this analysis actually works. After that, we'll take a look at the real-world signals and weigh them against the noise and the risks involved. And we'll wrap up by seeing how all of this gives the modern analyst a unique edge.
All right, let's begin with a fundamental idea here, which is moving past the hard financial data and looking into the text itself. This is really about understanding the what and the why behind this whole field of analysis.
This quote really gets to the heart of it. The central idea is something called informational asymmetry. At its core, the belief is simple. A company's leadership always knows more about its health and its future than the public does. And their choice of words, whether they sound confident or cautious, clear or, a little convoluted, can reveal some of that hidden knowledge.
So that brings us to a nice, clean definition of the practice. SEC filing sentiment analysis is really the process of taking subjective language and systematically turning it into objective, measurable data. It's about quantifying the tone, the perception of risk, and that underlying confidence that management is communicating in these official documents.
Now, this entire strategy really stands on three foundational pillars. First, as we've talked about, is that informational asymmetry. Management knows more, and their language can be a tell. Second is the idea of market inefficiency. Because reading and analyzing thousands of pages of text is incredibly difficult, most investors simply don't do it, and that creates an opening for those who can. And third, and this is the crucial part, is that research has shown, time and again, that the tone of this language can actually be a predictive variable for a company's future performance.
Okay, so now that we understand the why, let's transition to the how. How do analysts and, these complex algorithms actually pull quantifiable meaning out of these incredibly dense financial reports?
Well, there are two main methods. On the left, you've got the classic approach, which is dictionary-based. It's fast and pretty straightforward. You take a master list of financial words, you label each one as positive, negative, or maybe uncertain, and then you just count them up. But the modern approach on the right uses machine learning. And here, AI models are trained specifically on financial language to understand not just individual words, but their context and nuance, which, as you can imagine, provides a much more sophisticated and accurate reading.
And here's a great example of that dictionary method in action. The Loughran-McDonald dictionary is a well-known industry standard, and you can see it's not just about good words or bad words. It has these nuanced categories like uncertain for probabilistic language or litigious for tracking legal risk. An analyst can measure the change in the frequency of these words from one filing to the next to detect these really subtle shifts in management's outlook.
But the real evolution in this field came with models like FinBERT. Now, this is a version of Google's powerful BERT language model, but it's been specifically fine-tuned on millions of financial documents. Its key advantage is that it doesn't just count words, it actually understands context. It knows that a phrase like increased costs is probably a negative signal, but maybe not if it's in the same sentence as even greater revenue growth.
And that leap in performance is really significant. On a key financial benchmark dataset, FinBERT achieved 86% accuracy in classifying sentiment. This is a huge improvement over the older methods, and it really demonstrates the power of having a specialized, context-aware AI to extract a more reliable signal from the text.
It's also important to understand that analysts aren't just reading these massive documents from cover to cover. They focus their powerful tools on very specific high-value sections. The risk factors section, for instance, is widely considered the most predictive for future stock volatility. The MD&A provides management's direct, unfiltered commentary on performance, and forward-looking statements give you explicit clues about their expectations for the future. This brings us to what might be the most important question of all: the so what? Does all of this complex analysis actually translate into a real-world edge? We need to explore the evidence and understand the fine line between a genuine signal, random market noise, and, of course, the inherent risks.
This really is the critical question, isn't it? It's one thing to create a sentiment score from a document, but it's another thing entirely for that score to have any real predictive power over a company's future. So what does the research actually tell us?
Well, the evidence from numerous academic studies is actually quite compelling. The tone in these filings has been shown to contain information that helps predict future stock returns completely independent of what you'd find in the financial numbers alone. It also forecasts volatility, helps detect fraud by flagging strange shifts in language, and, in some cases, has even been shown to predict bank failures more effectively than traditional metrics.
However, it's absolutely crucial to maintain a balanced perspective here. Is this method some kind of infallible crystal ball that can perfectly predict market movements? Well, the simple answer is no. Like any analytical tool, it has its blind spots and some pretty significant limitations.
It's really important to be aware of the caveats. For one, the predictive power of sentiment tends to show up over weeks or months, not in day-to-day trading. There's also a growing risk of what's called tone manipulation, where companies might use their own AI to make filings sound more positive than they really are. And with these modern AI models, there's the black box problem. It can be tough to know exactly why the model arrived at a certain score.
So where does this leave us? In our final section, we're going to look at the now what, how modern analysts and investors are integrating these tools not as a standalone solution, but as one piece of a much broader, more sophisticated framework.
You see, sentiment is rarely used in a vacuum. Instead, it becomes a powerful layer in a multi-factor strategy. For example, an analyst might look for extremely negative sentiment as a contrarian buy signal. Or they might combine a positive sentiment shift with positive price momentum to help confirm that a stock's upward trend is sustainable. It's all about integration, not isolation. And the applications for this go far beyond just short-term trading. For long-term portfolio managers, tracking the sentiment of risk disclosures can help them dynamically adjust a portfolio's overall risk exposure. For credit analysts, a deteriorating tone can serve as an early warning of a company's weakening financial health. And it's also a powerful tool for automated due diligence, flagging issues that warrant a closer human look.
This all leaves us with a final, really fascinating question for the future. We are entering an age where a company's AI might write its financial reports, carefully optimizing the language, which are then read and analyzed by another investor's AI. In that kind of automated feedback loop, where does authentic human insight end and algorithmic optimization begin? Where will the real signal actually lie? It's a challenge that will likely define the next chapter of financial analysis.